Good afternoon, everyone. Thank you for joining us today, and welcome to the second installment of the Lone Vision Industry Insights webinar series. My name is Jordan Pavelka. I'm the Marketing and Communications Manager here at Lone Vision, and today I am joined by Jim Deitch, who will be leading the discussion on today's topic, the emerging role of financial executives as business strategists. Excuse me. Jim is an entrepreneur, a banker, executive, writer, advisor, and all-around mortgage industry expert. He's founded 2 national banks, several mortgage banking ventures, 4 technology-oriented companies, and has written a number of industry-related books. He's incredibly knowledgeable, and in my personal experience, is always willing to help and share what he knows. Jim, how are you doing today?
Jordan, well, thanks for having me.
That's wonderful to hear, Jim. Before we jump in, I have just a couple quick housekeeping items. We are indeed recording today's call, and we will be sharing it with all registered attendees. All attendees are also muted, but we do want this to be interactive. So if you have any questions at any time, there are 3 ways you can get them to us. You can send them via the chat box, the Q&A box, or if you would prefer, you can hit the raise hand button, and we'll unmute you for you to ask your question. So without further ado, I'm going to pass the mic to Jim so we can get started.
Well, thanks everyone for attending. Ladies and gentlemen, welcome. And wanted to talk about the emerging role of financial executives in business strategy. And if we roll the tape back to the beginning of 2020, who would have guessed that toilet paper would be in such sharp supply and demand issues? The oil prices would crash, mortgage banking margins would be up, and that supply and demand in just so many things really would be altered significantly. So from that standpoint, let's take a look at just what's happened in the mortgage banking side. And from the data published by the mortgage bankers, it's been the best quarter ever in history. In fact, it's been so good that in talking to a lot of CEOs and other business managers have gotten the question of, well, what's going on and what's coming next? And their view is that, well, it's going to continue for the foreseeable future. And in many cases, it certainly may. But one of the questions that I really want to jump in on is what role as a financial exec can you shed, and can you help your team and your executive team really think about? So in looking behind some of the numbers on the profitability report from the MBA, margins are up 429 basis points all in on the top line, 262 basis points on the cost line. And in talking to one of the MBA executives, they said, well, Jim, $1.1 trillion in volume happens to do that. And in just 90 days, the industry refinanced or issued more than 10% of the entire mortgage banking balances outstanding in the United States. Think of it. Over the course of history, from the beginning of commercial mortgage banking in the early 20s, we got to just over 10 trillion or so in mortgage debt, and literally issued $1.1 trillion of new mortgages in the second quarter. The second quarter was the highest quarter of production in history, and it is the highest level of profitability in history for the industry. So the question is, what's next? And this is where I think financial executives can have a significant role in business strategy. I started my career as a CPA and a CFO, and I always wanted to contribute to the overall business strategy. And over time, have observed many CEOs and CFOs and looked at that relationship and really saw how that kind of nurturing of that strategic relationship was forged. So what I'd like to do in the next 30 minutes or so is give you one person's opinion on the structural changes in the economy. And this slide deck will be available if you wish to use it for discussions within your company. How financial executives can better join the conversation as a strategic partner, helping to set what's coming up over the next 2, 3, 4, 5 years. And part of that role is for the financial exec to provide context for the data and information that's coming at people so quickly. And to formulate a message, your message, regarding your view of the business future, and build, illuminate, and frame that message. And I've repeated it because that is the key thing for you to take away today. It's how you can look at all the things that are happening right now, because people are so busy just getting loans out the door, and thoughtfully put together a message regarding the business future and help build, illuminate, and frame that message. So one of the things that I took away from writing Disruptive FinTech and interviewing about 100 executives for that is that disruptive forces don't arrive with a bang, and they don't arise out of thin air. These disruptive forces arrived long before their impact was acutely felt. And in fact, many people said to me in some words or another, these disruptive forces were hiding in plain sight. And interestingly, I had a discussion with a physician friend of mine who said, we shouldn't really be surprised at all about the pandemic we're going through. We've had this before in differing degrees, but it seriously was just something that will emerge over time given the right trigger. So with that, I'd like to give you a little bit of a view as to how you might formulate a discussion within your company and within your peer group. And the name of that is really going from YGTI to ICTY. And this is a profound shift in habits, norms, and practices. What's this mean? So in January of 2020, the Federal Reserve of Philadelphia had a long set of history with what they call coincident factors. They were monitors of early warning economic change that looked at the total level of employment, the total hours worked, the unemployment rate, and the compensation paid on a 3-month period. And in January 2020, all of the states in the United States were essentially in the green area, showing positive growth. By March of 2020, many of the states had turned red, showing declines in activity. And this was one of the early warning signals that got the Federal Reserve to quickly make a between-meeting emergency rate cut, because the speed of the deterioration in the economy was so acute that the Fed wanted to get ahead of that. So you go to it, that YGTI, prior to March of 2020, was the way we basically ran our businesses and lived our lives. We went to entertainment at movies, concerts, sports stadiums. We engaged in the hospitality industry by dining out, by hotels, by tourism. We shopped at retail. We went to physicians and exercised at the gym. We worked at the office. Our children went to college and school. We attended residential lending conventions, and I think back to last year's Loan Vision convention and what a great delight it was to see people in person. And we got around with auto, public transportation, and airlines. So that you go to it prior to March of 2020 has been transformed as of May 2020 more into an it comes to you type of economy. So entertainment is now via Netflix or streaming services. Hospitality is by food delivery, curbside pickup, or potentially dining on the outside. Retail and grocery shopping has largely been superseded or run alongside by Amazon, Instacart, etc. Telemedicine and exercise at home is now de rigueur, and we're working from home via remote access and via remote technology. Schools and campuses are potentially largely online. We're doing an online lending convention, accounting convention, and transportation via auto or Zoom. It's amazing to see what Zoom and its public offering has climbed to in terms of share price, all because of the tremendous uptake in the Zoom services. By June of 2020, the Fed in Philadelphia not only had to change the scale, because previously the scale was up 1, down 1 for a 3-month period. The map of the United States turned to 20 to 30% reductions in economic activity in some states, and even in the most resilient of states, it was 1 to 5% down in the quarter. All of these changes, and here's where I think you as a financial executive can really contribute to the conversation, is these changes will have profound impacts, not so much right now, but as the next couple of years unfold, on housing prices, long-term employment level, affordability, the orderliness of a real estate market with predictable absorption, the commercial real estate rents, and the ability to see commercial real estate be sustained, and state and local tax collections. All these will have, I think, profound impact from the current coronavirus crisis. And there's differing impacts depending on where you are in the country. So housing prices with respect to price change, delinquency, inventory absorption, employment levels of remote versus on-site, and even the skill sets required. The service industry has taken such a hit in terms of the employment within it, in the hospitality, the airline, the restaurant, the travel business. Housing affordability, we should really keep an eye on. It's not only the PITI, it's especially the taxes and insurance, because the real estate taxes to absorb some of the reduced collections of sales and employment taxes, as well as the insurance cost, given some of the violence and protests in the city, T&I think is something we need to keep our eye on. The state and local tax collections, state and local budgets, the municipal bond market, and just the overall aspect of the ability for Americans to act with civility, to be safe, and to build on economic resurgence. All of these things swirl about as things for the financial exec to think about. So how can financial executives help businesses to see more clearly? And not only the mortgage banking business or the lending business, but all businesses where you interact with peers. The business conditions from January 2020 started out about the same point. It's been the worst of times for hospitality, retail, to a lesser degree for manufacturing. It's been the best of times for mortgage banking, as we saw in the quarterly release that we just saw from the MBA. As we, as financial executives and mortgage banking execs, think about what's on the top of our mind, there's a characteristic that I discussed at length in the FinTech book called the availability heuristic. And this means that your worldview is largely affected by information that's easily available to you. And sometimes you have to look far and wide to perhaps get a more clear picture of what's actually happening in the economy. Clearly, if we looked at just the mortgage banking industry and said, is the mortgage banking industry indicative of what's happening in the overall economy? The answer is clearly no. So that availability heuristic is really important, and it's the first takeaway for you to think about. We're exposed to literally every day. Margins are great, volumes are great, credit quality is good, we're as busy as ever. Getting loans closed is the constraint, and whether it's geographically for a lender in the Northeast, Southeast, Northwest, Southwest, the story is really very much the same. So from the mortgage banking map, if you looked at the United States, it's all green. And it is certainly my fondest hope that it continues all green for a very, very long time. But the question as a financial exec to think about is how should we be planning, investing in the future, using some of the blessings of the great margins and volume today to ensure we're sustainable over time. So mortgage banking has always been a cyclical industry. The 161 basis points returned for the second quarter is certainly a high watermark. But that comes from the fourth quarter of 2018, which was a completely different and very, very difficult time. the most important thing a financial exec can provide to the business operators is this context of that availability heuristic of things are really great right now is absolutely true, and it should be enjoyed and we should profit from it. But the fact that this is a cyclical business always needs to be in the top of our mind and the back of our mind. So some of the insights you might take away from going from a you go to it to it comes to you economy with respect to mortgage banking is that we've had some really good things happen on e-close. State regulation changes, borrowers and employees' willingness to adopt a more digital process has been a great gift of this particular pandemic. The ability to work at home has proved our industry's ability to innovate, to adapt, to adopt to surging volume, regardless of whether our teams are working at home, sheltering in place, or in the office. And there's a whole lot of other things which I'll be happy to discuss offline with you in this you go to it from an it comes to you change. Specifically for financial execs, the playbook opportunities. And when I say playbook, it's one should always know what is coming and have a playbook or a series of scenarios laid out to say, if this happens, I have a way to go to a particular strategy or a particular scenario that I've thought through. So that playbook opportunity can be either macro about the industry in whole, or it can be micro, looking at a specific thing like originator compensation or originator profitability, etc. 4 things to think about as financial execs looking forward. One is, although it might not be necessary for a year, 2 years, 3 years, 5 years, at some point, we're going to have to aggressively manage the cost base. The second, thinking in terms of mental models. What changes are going to happen both within the way consumers want to get mortgage loans going forward, and how will that affect the distributed retail, the direct-to-consumer, the wholesale, the correspondent channels? Will they kind of merge together a bit? Will they separate out into distinct channels? What will happen as consumers get more and more used to, it comes to me? As financial execs, right now, it's probably hard to demand measurable improvements in productivity, simply because people are so busy just getting the loans out is important. But several CEOs that I've spoken to in the last couple of weeks have said it's really important to think about how this industry will change and how we can reserve labor to the relationship activities as opposed to stare and compare or simply entering data or doing other things that sometimes the mortgage banking industry just seems to have way too much of. One CEO in particular said he is demanding a near-term ROI on fintech spend, because if he's going to build this business to be efficient, there has to be a measurable ROI from all the technology spending that's going on. And my pushback to this particular CEO was, what percentage of your total cost spend is really on technology versus labor? And he got this look and said, a lot. And my question, going back to my CPA kind of breeding, is, well, exactly how much? And we got into a relatively spirited discussion. And I'll share a little bit about that discussion with you in just a minute. So from my perspective, here's the business strategy opportunities for you as a financial exec to kind of put your own theory together on what's going to happen and demand a larger seat at the table to amplify some of the things that may be on your list that may be equal to my list, or perhaps you have your own items. But number one, margins will normalize, and the derivative elements of this will amplify when the pipeline starts to slow down. And that will always come as a shock to the business executives, but I think it's incumbent upon us to keep that in mind. Margins will normalize at some point. Second, I'll show you some history on compensation costs. But 65% of the total cost base in a loan is human labor. That's just going to be difficult to sustain over time. So the aggressive drive to harness technology to make sure that human labor is working on relationship elements and to ensure that the business is process-driven, not patched over with human spackle or technology spackle, as my friend Jonathan Core from Ellie Mae likes to say, will be really important. Another thing is these changes, as you begin to bring them up, will likely be resisted by origination and operational executives because the status quo is what they know and it's working right now and everybody's doing really well. Thus, the need to position this discussion not as something we need to do right today, but something we need to do to be able to transition in the reality of what the lending business may look like 1, 2, 3 years hence. And that successful lender will be data-centric, both in terms of customer data directly sourced from third parties, whether it's day one certainty or form free or Finicity, but also harnessing the lender and industry data that's available to us. So aggressive cost management, believe it or not, will be a key competency in the coming years. Maybe not next year or the year after, but it will become a key competency. And what we're going to do with a remote workforce with respect to office space needs, the regional cost base of where we find employees, the tech spend to manage remotely, and the tech spend to essentially increase the productivity of the human capital that we use. Two other points, making sure loans stay sold is really important. Some of the quality of what's being sold today, because we're so busy, there may be some defects. We've seen some of those defects rearing their ugly heads, and keeping an eye on quality is super important. And lastly, as a financial exec, it's where the puck is going, not where it's been. So it's great we had 161 basis points of profitability. It's great we had that best year or the best quarter ever in origination. It's great that we made more money than ever before. But it's important to think about where that puck is going. Here's a couple things to consider. Over the last 5.5 years, the percentage of personnel cost or labor in the total cost component has been about 2/3 of the total costs. And interestingly, in the second quarter of 2020, despite all the absorption of having so many people so busy, it's still 69%. And technology-related expenditure is about 2%. Those two factors, in my view, are opportunities for change going forward. And if one looks at the second quarter 2020 MBA performance data, as a percent of costs, not as a percent of as a percent of total revenue, not only just costs, it's still 47% of total revenue consumed by compensation. When we look at that and see that 130 basis point kind of average on a per loan basis over time, one hopes it will continue. One suspects that will eventually be some pressure on margins and costs. Said another way, mortgage lenders spend almost 23 times more money on compensation than technology. For those of you that watch Shark Tank and can think of Mr. Wonderful Kevin O'Leary, if you went on Shark Tank and said, my business spends 23 more times on compensation than technology, his comment simply would be, stop the madness. It's just crazy. This is not sustainable. And it's not. When you have such a high labor content, the variation in productivity, performance, customer service level, quality, the ability to get scale in a way which is not just working people as hard as you possibly can, but to get that significant and ongoing productivity gain takes some time. One scenario in a playbook is to imagine what happened, for whatever reason, if mortgage banking declined quickly. So how would one manage? What would you do with productivity? What playbook have you developed to say, these are the next steps that we're going to do? Are you ready to provide leadership in that effort? Do you have your theses or scenarios or business impact analysis to be able to go through and help shape future response? We're all so busy living in the present. The opportunity for you as a financial executive to kind of push forward and think about these things, I think is a real opportunity for you to earn a larger seat at the table. One playbook opportunity to think about is the relative performance of employees. One of the CEOs I spoke with a couple of days ago said, Jim, it's really interesting that right now, almost anybody who can do a loan, regardless of their ability or their productivity, we need them simply because we just have so much capacity that we need to be able to push through, that every employee is, regardless of their ability, we're going to just continue forward. And certainly for the current period, that makes sense. But as a financial exec, you can look at kind of that bell curve of what the distribution of employees happens to be. And pre this crisis and pre the volume, you could probably go through and say we had a great group of people who are, solid average performers. We had a group that are above average, and we had some that we'd love to coach up or perhaps trade up. And they roughly, in looking at studies from a lot of different companies and different industries, kind of go about 70% in that middle of that good solid performance pack, about 15% that are on the upper end of that performance are truly exceptional, and about 16% that need a lot of either training, rehelp, or to be invited to work for a competitor. So one of the things I'd like to do is just give you a quick look at a way to think about the ability of individual employees, individual branches, and just looking at a retail model.
I'm going to take a look at the contribution of loan officer and branches to the profitability of the company. And what I have here is all of the branches now looking at one particular branch broken down by loan type, and looking at either the buy price, which comes out of the LOS, or the sell price, which is attained on sale. I can also go through and look at the entire company, in this case year to date, and I'm going to pick one branch, in this case branch 46, and look at Jane Corleen and look at her production by conventional, purchase, refi, and there I have all of the information available to me on the profitability generated at the revenue side. So I've got the base buy, the contribution, the weighted average sell, the net sell, and in looking at the detail, I can go through and look at this by date range. So in this case, I'm looking at just one branch. I can then isolate into a particular loan officer, and now I have the results for that loan officer. I can see anything below par is highlighted in red to draw attention to it, and also the lien position where I have first and second liens. I can sort it just to look at the first lien, see the investor it's going to, and get a sense of what the overall activity looks like. In looking at it by branch again, I can do it by loan type. In this case, I'm going to go and look at a particular loan officer and look at their activity over the last 14 or 15 months. And one thing I can do is examine any of this by loan type. And if I want to go in and get a little deeper dive, I can go in, pick a month, and then look at the particular detail by VA conventional. And even if I want to get down to the loan number, I can go through and look at each of these loans, buy price, sell price, and get a sense of how that is working. One of the great aggregation features of Coheus is the ability to look at buy price, sell price over time. You see we're in the current month, so the sell price hasn't fully been posted. If I just look at the last 7 months, I can see exactly what's occurred during those periods, and you can see some of the margin increase that happened in the May-June timeframe. And we can take a look at contribution to profit. This is looking at the total pipeline. I can look at lock, unlocked. I can look at it specifically by branch. So again, I'm going to go back to branch 46 to take a look at that particular branch. And what that gives me is the locked pipeline, the loan amount I can look again at any particular loan officer, and this is a scorecard of everything in their pipeline by margin. In the case here, I've anonymized the data, so the margin is all the same, but whatever the actual margins are would be available to you. So this is how one can go through and provide the insights to production management of how each branch, each channel, each product, each loan officer is performing, and also to take a look at the activity for the secondary side of things and the difference between the buy price and the sell price.
Going back to the branches, that top 16% or so of the top 16% of the production people in terms of both branches and originators are clearly way above average and produce a way above average amount of profitability. Likewise, there's another 16% that literally are not profitable, that are detracting from the total team. And that solid piece in the middle also has some variations. So the key is to think about in advance how to sort through that and to be able to go through and see those differences and plan on what would happen should margins change. The other thing that we can do is take a look at the distribution of employees on the operational side, the managerial side, the support and personnel side, and the administrative personnel side. So clearly going through and thinking about how do we determine, should we want to optimize our workforce and really work on efficiency? What's the playbook to do so? So that's one takeaway, and because personnel costs are 65, 70% of the total dollars that you spend, it's really the place to look to lever productivity. Another thing to look at is potentially how you as a financial executive can provide context and the ability to provide insight in the way that you present financial information. So I'm going to pop into Loan Vision to something that Loan Vision and Teraverde has worked on. And certainly you can look at the typical way of tabular data. But one of the things that the team has done is to produce something that provides some context. So in this case, the ability to look at where the volume's coming from, look at month-to-date statistics, explode that data out, get into both basis points and average per loan against the context of gain on sale trend on the right, compensation expense is really important. The ability then to push this out and easily get at that data coming out of your Loan Vision system and look at it just literally with one click from in Loan Vision out to Excel in the same format of what you see is what you get, could be a way to help you present and form information that's a little easier for executives to understand. Also in terms of variances, it's really important to have the context, and when you look at variance, it's hard for non-financial executives to necessarily understand it. So think about how you might present variances. In this case, worked with the Loan Vision team to say green is good, red is not so good. And as you explode out particular elements of the chart of accounts, to see the pluses and minuses both in terms of dollar variance and percentage variance is sometimes useful to provide context. Keep in mind, it's tough sometimes for non-financial people to keep the signs right, to keep the presentation right. But in this case, you get a sense of where the variances are in my revenue and where the variances are in expenses. Also, while providing some context on the right-hand side with gain on sale, sales commission, etc. So you can certainly look at the traditional tabular approach, and that is very, very helpful. But as you present data, the ability to think about and present visually appealing and visual elements that tell a story are super important as you get your seat at the table. And that seat at the table includes both retail, consumer, broker, and correspondent lending operations. So Jordan, was that you?
Yeah, it looked like we had a hand raised. Kurt, if you wanted to go ahead and talk, I've given you the ability to talk. You'll just have to unmute yourself. Kurt, are you there? Right. Apologize. Jim, go ahead and continue.
Yeah. Okay, and if by chance you can't get the question on the phone, you're certainly free to chat it, and Jordan can pick it up from the chat box and relay it. So as we think about some of the opportunities for a playbook, whether it's retail, consumer direct, broker, mini core, correspondent, all of these opportunities, I think, exist by channel. So as a financial executive, wanted to just continue to reinforce the ability that some of the forces that are facing us today and some of the forces that will affect our future going forward aren't necessarily going to rise with a bang. They're already here. And in many cases, some of these elements were hiding in plain sight. And your opportunity as a financial exec is to scan the overall horizon of the lending environment, the business environment, the economic environment, and to be able to take what you see and formulate it into some series of scenarios or playbooks that say, if this, then that. And once you've formulated those, the ability to sit informally with your executive team, with the operational and production team, and just have these discussions is just super important to ensure that that availability heuristic, what we're seeing day in and day out, is balanced with some things will change. They may change fast. And for the financial executive to have that role that says, I'm looking at today, I'm looking at next quarter, I'm looking at next year, I'm looking at the next several years, I think will add to the value of what a financial executive brings to the table, but more importantly, will add to helping the companies that we all work with achieve a greater future, a more stable future, and a continuing contribution to helping people buy, afford, and enjoy the homes of their dreams. So ladies and gentlemen, that is the conclusion of prepared remarks. Really appreciate the opportunity to talk through some of these thoughts with you, and would love to take any questions that you may have. Jordan?
Yeah, so while we wait for those questions to come through, I did have a question for you, Jim. Where can they find your most recent book on disruption?
Yeah, so you can get the book in a couple of ways. One is it's on Amazon, as are all of the books. But as Lone Vision clients, I've always had the desire to provide a complimentary copy. So if you want to shoot me an email with your mailing address of where you'd like to have the book, I'd be happy to send you a complimentary copy. And if you ask, I'd be happy to sign it and autograph it for you if you'd wish.
Oh man, I think I might have to get myself on that list. Well, it doesn't look like we have any questions coming through today. Jim, was there anything else you wanted to touch on before we wrap up?
Well, I'd like to, Jordan, thank you, Martin, the entire Lone Vision team for having an opportunity to spend some time with your customers, and really appreciate all of the folks in attendance. I very much appreciate you sharing part of your day with me, and hope that you have gotten a little bit out of our 30 minutes together, 35 minutes together. And would also offer that if you'd like a copy of the deck, we will get that to Jordan. If you have any thoughts, or you want to just bat around some of the ideas, or challenge some of the ideas, or provide some additional input, I'll be happy to take your call. I'm always very interested in talking with other financial executives in the industry. So Jordan, really appreciate the time, and really appreciate the opportunity to be part of the Lone Vision series.
Yeah, Jim, you know, we always love having you, and I want to thank you as well for sharing your knowledge and your point of view with us today. I want to thank everyone also for tuning in. A special shout out to the sponsors of our Industry Insights series. We'll be continuing next week on Wednesday at 3 p.m. with Tyler Dorner of WhatServe with a discussion on the technologies that lenders can leverage, which is a nice follow-up to Jim's point today. On expanding your technology budget. We hope to see you guys there, and thank you. Have a wonderful rest of your day. We had a question. Jewel, I'll get you connected with Jim. If you guys want that book, you can send me an email, and I'll get you connected with Jim to get that newest book over to you guys. Thanks, everyone. Have a wonderful rest of your day.
All right. Thank you. Take care.